Good morning. It is Friday, April 9th, 2021. This is at Goldfinger on CEO.ca, at CEO Technician on Twitter. You can also just call me Rob or Robert. I think I want to talk about junior mining, just something that I've been seeing a lot lately. When the sector is hot, gold is going up, everybody's making money, there's not a lot of focus on risk and what the downside can be. I've written a lot of articles about red flags in junior mining, pitfalls to avoid. You can search co.ca or Google Goldfinger, junior mining, red flags, pitfalls. And there's quite a few articles out there. I've been blogging on co.ca for about, I don't know, 6 or 7 years. But I did a post a few weeks ago called The Truth About Junior Mining. And so the point of this was to just lay out some truths, that things that I've learned from being involved in the sector for over 3 decades. So during 3 decades, 2000s, 2010s, and now the 2020s. I started in about 2003, and I literally did not know anything. My first junior mining stock was Northern Dynasty. I bought it in, I think it was the summer of 2003, and I got very, very lucky and essentially made a lot of money on my first trade in the sector. And obviously that set me up for some big mistakes, later on, because of course, when we have a big win, we think it's easy when we don't know anything, right? So going back to this article, just laying out some cold hard truths about the sector and how a lot of companies don't do well, they fail. It's tough to make a new discovery. The process of doing real exploration is capital intensive, requires money, requires skill, expertise, and quite a bit of luck, quite frankly. So a lot of companies are just not going to be big winners. That's just the cold, hard truth of the situation and the probabilities of the sector and of exploration and Mother Nature. And so you can review this post yourself. I don't need to talk about every single thing I wrote here, but I also talk about some of the good things about the sector. The good things are that you can have very large gains. So you could buy a Walmart stock and get a dividend and maybe get a 10% return, on average every year. And if that's the sort of investing you want to do without a whole lot of downside, then buy bonds or buy Walmart or buy Coca-Cola, then this sector is not for you. But if you're willing to risk quite a bit, you have the chance to have a 10 or a 20 bagger. And I'm going to talk about some of those upsides, some of the best examples in the sector, of how big the wins can be potentially, right? To have something go up 1,000%, to have the potential for that to happen, the reality is you have to be willing to take a lot of risk. You can't have one without the other. If you can find an investment that has the potential for a 10x upside, but only 10% downside, well, then you're probably being lied to. Or it's an illusion that the risk is only 10%. Okay, that's the reality of investing. That's the reality of financial markets. I also wrote these posts. So there's 3 of them. The junior mining red flags. This was from 2018, and I talk about just things to look out for when you're following junior mining companies. And I think that this is important. Like all of these things that I wrote about still apply to this day. Things haven't changed in 2.5 or 3 years. So here this morning, as I said, the reason why I'm doing this video is I think it's important for people to understand the risk that they're taking in buying junior mining stocks and companies that do not generate cash flow. Most junior mining companies are not cash flow generating. Most of them are having to come back to the market to raise money, to fund operations, to pay salaries, to drill, to do VTEM work, to do whatever, right? Everything has to come from shareholder capital. So these are the risks. The junior mining companies do not generate cash flow. And so there's no underpinning of valuation. Like when we talk about Coca-Cola or we talk about Walmart, we know what their earnings are or what they were last year and what we think they're going to be this year. And then we can imply a valuation based upon a valuation multiple, based upon the 10-year note yield and all those different things that the analysts use to value a company. But we know that Coca-Cola and Walmart are going to pay a dividend. We know what their profitability is, roughly speaking. And so that's the valuation foundation for a big multinational company like that that's generating profits. Junior mining companies generally do not have cash flow. They do not have profits. And so their valuation is very much more subject to the whims of market sentiment. And so junior mining stocks are highly sentiment driven and they're illiquid. So one day a stock might trade 500,000 shares if it has news. It might be a 50-cent stock, 500,000 shares volume. So that's $250,000 of trading volume on a day when it has news. And then it might not have news, or the interest in the sector might tail off for a few weeks or a month. And that volume might drop down to 50,000 or 75,000 shares a day, right? And sometimes the share price will also drop as volume drops just because the buying interest isn't there. And remember, these companies don't generate cash flow. So there's always 100 reasons to sell something. Oh, I need to buy a car, I need to pay my taxes or whatever it may be. And there's only one reason to buy something. Well, I think it's going up. And I like, the stock, as we say from GameStop, I like the stock. Junior mining stocks can fall 90% plus or even lose all of their value over time. So we saw that during the bear market years from let's call it 2013, 2014, 2015, even into 2018, we had some very rough years or months. So during those times, you have a few years in a row where the sector is very much out of favor. The metal prices are not doing well. The companies need to, again, fund their operations. So there's dilution that occurs. And so you could have a very painful cycle during a bear market, which can cause, companies to lose 90% or more of their value. So that's one of the big, risks of investing in this sector. Companies are forced to raise money, so that you have that, fundraising risk, capital raising risk. That's always present. We saw last March, the market sort of just seized up and there weren't really any financings done in the sector because the world was shutting down and everybody was afraid. So that's a risk. And then suddenly in June, throughout the summer, suddenly the markets opened up, became very liquid, and capital was available again, and companies were able to finance, right? So not only are there micro risks such as management execution and exploration risk, you can miss with the drill, not find any copper or gold or what have you. There are macro risks, including the cyclical nature of metals, and overall market risk, right? So like we saw last February and March, the market just had a heart attack. So that's always possible, right? It's not likely. It happens once every few years, but it can happen. And so you're taking that risk. And so the point of these five bullet points is to just lay out the risks. There are risks in investing in anything. And there are a lot of risks in junior mining. But the reward, so this is why, if you just had these 5 bullet points and there was nothing else here, you'd say, well, this is crazy. I would never buy a junior mining stock, right? It doesn't make any sense. There's all these risks. I lose 90%. There's no guarantee that they're going to find anything. Meanwhile, I have to pay the CEO salary and I have to pay the rent and the listing fees, et cetera, right? The expenses add up. But the rewards are also very high. Potential rewards are very high. Junior mining stocks can experience very large share price increases, including more than 1,000% in the best outcomes. So, how many investments, honestly, could you have 1,000% return in a year? There's not many, right? I mean, obviously, we've seen some of that lately in the markets, but generally speaking, that doesn't happen very often, right? So the potential for that return, and in examples like Great Bear, we're talking more like 100x, right? So 10,000%. Extraordinary returns, life changing if you're in at low prices and you're able to hold along the ride, right? And benefit from the upside. Well managed companies that execute efficiently and meet stated milestones can generate considerable market interest, right? So, CEOs and management teams that do good work, that advance projects, get a little luck too, can see considerable share price appreciation. So, just a few GBR. Van Gold, was one as well recently. So look at Van Gold from April. So this is 1 year. Van Gold went from a few pennies, I think it was 3 cents or 2.5 cents, to a recent high above 70 cents. So what's that? That's 25 or 30x in a year. That's extraordinary, absolutely extraordinary. So this is one of the examples of best case, you know. And honestly, when I first started buying Van Gold, I think it was in May of last year. I think it was 7 or 8 cents. Not a whole lot of people were talking about this, right? This was still very much under the radar, very, very new story. And the company met milestones and advanced its project and then acquired a new project and actually, to be honest, yes, the gold and silver prices during this time was very helpful. But since August, gold and silver have actually been a headwind, and Van Gold has still gone much higher, right? So this is an example of one of the best case outcomes for shareholders. Another one. So I notice a lot of people on CEO.ce especially, they get very impatient. Their stocks are sitting at whatever it is, 6 cents or 10 cents, and they're just going sideways for days or weeks. And they're saying, why isn't this going up? Well, the market doesn't have to do anything, right? And very often, so in the case of Banyan Gold, I was buying the stock in 2017, and I didn't move the chart back that far, but you can see that basically I sat here for over 2 years with the stock trading between 4 cents and 8 cents, boring us all to death, right? And even when the market had the heart attack last March, Banyan briefly dropped to 3.5 cents. And, do you think I sold there? Absolutely not, because nothing fundamentally had changed with this company. It was just moving between 4 cents and 8 cents based upon market sentiment. And, week to week, one person wants to sell 100,000 shares, one person wants to buy 50,000 shares, and that's creating relatively large moves in the value of the company based upon the whims of a few investors. And that's, again, one of the challenges of junior mining, right? When there's relatively low interest, the share price can actually be very volatile. And then we obviously got 2020, and things turned very, very aggressively in May, and Banyan peaked in late August. So it went from 3.5 cents at the March low to 39 cents at the August peak. So that is more than a 10x. And again, that's one of the examples of what's possible in the sector and why we even bother to follow these companies or buy these stocks in the first place, because the potential upside when good things happen is so great. But you can't have the rewards without the risk. And the risk is, again, you can drop from 8 cents to 3.5 cents in a month just because of overall market risk. Nothing fundamentally changed with the company, but market sentiment changed a lot. And you can also just have your money sit there for months or even years, going nowhere and doing nothing. Again, that's one of the risks of the sector. It's not for everyone. Pitfalls. Oh, and I do want to say, also one of the potential upsides is timing trades. We very often see stocks can move up 50% or more over a couple of weeks or even a couple of days. And if you can time those trades, I don't know, around news flow, the starting of a drill program, the results of a drill program if they're good, or just see more interest come into a stock for whatever reason, right? You can see pretty good trading opportunities. That's not so easy to do. That's something that I do try to do from time to time, but it's not for everyone. Pitfalls. So we'll just wrap up here. Some of the biggest, mistakes and pitfalls that you can make as an investor in the sector is just chasing something, buying a stock because it's up a lot and you don't want to miss out. So that's FOMO, fear of missing out. That's also greed. And greed kills, especially in financial markets. Another big pitfall is blindly following someone else. So you just see some people talking about a stock on Twitter, on CEO, or wherever. You read an article and, okay, I'm just going to buy because it sounds good and other people are buying it and it's up. But you're not actually finding out why you, capital YOU, are buying the stock for you. And also assessing what you're willing to risk. What if it drops? What if you actually bought at a bad time and it drops 30%? What would you do then? And these are all important questions that you need to ask before you buy something. Also, one of the other big pitfalls is people take too much risk. So generally speaking, I will never put more than 10% of my money in a single stock. And in the junior mining sector, it's often not more than 5%. So you need to assess based upon your risk tolerance, based upon your income level, based upon your time frame, how much risk you're willing to take. And, if you're buying so much of a stock that a 30% or even a 40% drop in the share price would significantly affect your quality of life or your mental health, then you are buying way too much. You're taking way too much risk. Again, chasing a hot stock after a big run and not understanding the downside risk, big mistake. Buying a stock that has a very active channel on CEO.ca with highly skewed bullish comments. So I call these cult stocks. We've seen that with Garibaldi, late 2017, early 2018. The stock was, $5 or something, and now it's trading about 50 cents. Sona went up to $16. Now it's about $1.60, right? So it dropped 90%. And at one point, Sona had more than 1,000 people on its CEO channel, and the sentiment was wildly bullish, right? Usually not a good time to buy a stock. The biggest pitfalls just in general in markets is buying stocks at very high prices, taking too much risk while not understanding the volatility that stocks can have, especially in the junior mining sector. All mistakes in markets and big losses usually stem from some combination of greed, lots of excitement, excessive sentiment, over bullish sentiment, and people betting too much, betting more, buying more than they can truly afford and tolerate in the event that stocks actually go down for a while. All right. So I hope this helps. My point in this is to get people to think more when they're buying a stock, especially a junior mining stock, and the risk that they're willing to take. Once we've properly assessed the risk and we're comfortable with the risk, the upside usually takes care of itself. Thank you for your time.